I bet that you will understand more about economy than anything in today's video. So let's start. So this is the economy, how it functions. We will be discussing the entire how actually what is economy, how it works, all the sales cycle, everything will be mystified, and you will know the exact processes, the exact principles which are used by billionaires, millionaires to invest. They don't see candlestick patterns to take such enormous decisions. They understand different things. They understand economy. So you also must understand economy. We will go in very minute details. See exactly how everything is going. The economy is just a whole lot of commodities being exchanged in place of for cash and credit. That's it. So let's study. We will understand productivity growth, short-term debt cycle, and long-term debt cycle. So for uh, for for giving you some context, we will be exactly mystifying what does this cycle mean, the entire transactions, how they happen, how they shape our economy, the buyer, seller, how they exchange, what is the significance, the exact significance probably no one will tell you. How a transaction happens. Obviously, a transaction is just stocks or goods being exchanged for money or credit. Credit means a loan taken from bank or an educational or a financial institution. It can be any sort of loan. So any transaction is based on money and credit. This makes the total spending of any individual, any government, anyone. This total spending when divided by the total quantity gives us the price. This is the price which we paid for that particular service, for that good, for that stock, for that bond, whatever be the case. So this is how the transactions happen. So all these transactions at a greater scale means tons of thousands and millions of all these transactions together make a market. These markets such as wheat, cars, stocks and oil and gold and fruit, fish, chicken, capital, cheese, etc. All these constitute together to make one single economy. For example, the national economy. So we will be studying both these concepts, total spending, total quantity, to get ourselves well equipped with investing, trading, so that we can understand how actually money works. All the transactions that happen between between financial institution, educational institution, banks, governments, buyers, sellers, everything is based on just transactions. So a government and bank are the main constituent elements of of a economy. They are both one. For example, in India, it would be Reserve Bank of India and Indian government. Both of these function. They are not controlled by one individual. They use different methods. For example, central bank, for example, Reserve Bank of India or SBI will use two methods known as the interest rate. They will high or lower it, or they might print more money. We will understand credit, which is the most important part of an economy. So let's get started. So there is a typical buyer and a typical seller. Both of them begin a transaction, and a lender, borrower. This the A lender may use credit also. For any transaction, there might be money or credit involved. A typical borrower may have some credit from the lender, which is a bank in this case, so that he can buy assets such as cars, gold, or things like that, or even for his own desires. So in future he has to pay some principal amount and some interest. If the interest rates grow more, less number of borrowers will be there, and if interest rates decrease, a greater number of buyers will be there. So this is how a typical economy would be working. Lender and borrower, they will exchange credit, will be given in terms of whatever interest he will be ready to pay in the future. So this is how an agreement or a credit is made. This credit has two components, debt and the actual credit, though they both are used interchangeably. So what we will be considering now is that credit is asset for the lender, whereas it is liability for the borrower. Obviously, the borrower has to pay a greater amount of sum, the interest rate, apart from the principal amount, to for the settlement. So this is how a typical visualization will work. If interest rates are more, then lesser number of buyers will be there. If interest rates are less, then more number of buyers will be there, because we all want to pursue greater dreams. And what about free money, which we don't have to pay later on? So this is how a typical cycle works. We exchange commodities, goods, gold, service, bonds in exchange for money. And after a lot of these cycles have occurred, if interest rates is lower and the person is a credit worthy borrower, he has the ability to repay and he has a collateral, then he is considered credit worthy. So if a person is credit worthy, that is he has income and that is he has collateral, he can invest. For that investment, he can demand the government or the banks to give him some money. So income, then borrowing, then spending. This spending is someone else's money. So if one person is spending, then other person is earning. This should be very, very, very important concept. If one is spending, other is earning. One is spending, other is earning. One is spending, other is earning. So these cycles. For example, if I purchase some stocks or bonds for some money, then this money, when gone to the seller whom I bought the goods from, this seller will have a greater sum of money because I bought it at a credit. This credit, because of this credit, the next borrower has a greater amount of money which he can use later on. So productivity matters in long run and credit matters in short run. To understand it, I know it will be slightly confusing, but let's go and dig deeper about all the productivity lines, the credit cycles. If we have credit more than that we produce, that is, if we have lower interest rates, that is, we as a, so this which you are seeing, this is a small part, this is a very, very, very small part of the big curve. So we will be digging deeper down into short-term cycles and long-term cycles. Short-term cycles are the ones which are typically 5 to 10 years long, and they depend on the credit. More the innovation means more credit was taken. More credit was taken means interest rate was low. So of a typical scheme, this income, spending and productivity. If income of one, if there was no credit, let's suppose that we eliminated the credit, then the only way to innovation was to increase your productivity. This would mean that we can't borrow. For example, if one has to make an investment of 1 crore rupees, he can't, because if he wants 1 crore, he has to do the work of 1 crore. He can't just have some assets that can repay the money. For example, this is actually the human nature. If nobody will want us to support, then how can we grow in initial phase? This is typically depicted from this chart. If we keep on credit, if at some portion we take a lot of credit, then at some portion we have to take some lot of debt. If we won't take, then someone else will have to take, because economy is just transfer and transaction of money. If you didn't understand, that's not case. Just analyze that if I have taken some credit today, to repay it, I would have to cut down my expenses at some later point of time. For that, I will have to have some money at some later point of time. This means if at some point I have greater money, at some other point I have less money. So this actually creates that short-term cycle. For example, if you go to a bartender and request him for some cold drink in exchange for credit, he gives you based on your trust some credit. You decide some credit that I will repay some extra interest rate apart from this principal amount. Then actually this is how the economy literally works like. 97% is just credit, 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 and just 3% is actual money. This 3% constitutes the total spending of any individual. The more there is a lot of credit in economy. Without credit, it would be just an increasing economy. But with credit, there has to be some bumps and humps of these long-term and short-term cycles. So credit is when a credit is bad. A credit is bad when it becomes a liability and it is an asset. When it is an asset, for example, if you purchase a truck with the same money, or you purchase some television. Television is just waste if you don't have the money to repay it at that point of time. In fact, good decision would be to buy a tractor, and the tractor will give you a recurring revenue or a recurring income, which you will therefore evolve into some money. All this money taking income and spending it, taking income and spending it. The income of one is spending of others. So, if I have earned $1,000 and I have $10,000 credit worth, then I can spend 110 grand for something. Where and from whom I am purchasing this 110 grand, that person has credit worthiness of 11 grand. Now this 11 grand and 110 grand together will make him 121 grand. This 121 grand, he will purchase something from in exchange for his good or service. Because of this service, that person will have greater credit worthiness, because of which he would be able to get the same thing for some greater amount. This actually creates a boom in the economy because of credit. For example, if there is, think of it like that: if someone is willing to give you free money, for example, free money means either you take it now, for example, 100 rupees you take it now and repay it later, then its worth today of 100 rupees has decreased a lot. And therefore spending and quantity, they both influence the price of a thing. If spending is more, if people will spend more, if they think that today I will take this 100 rupees because I have to only spend back the 100 rupees, then the price will definitely go high. But government does not like this. Government does not like prices being extremely high. This phenomena is called as inflation, the mysterious word which you think. This phenomena of increasing prices. For example, if everybody gets a lower interest rate and everybody takes things on cycles, there would be an obvious increase in price. Obviously, because one person can easily get that for greater sum in the hope that he will pay it later. Because of this paying in laterness, he will have increased the economy. But government does not like this. So the government increases. This is where the turning point comes. This is where the turning point is. So let us understand what actually happened. So actually what happened was, after a boom in the prices, after the prices became enormously high, what government thought? Government thought that this prices is not at all suitable for a person who did not took credit, because it just created a boom. So to relieve other persons, government increases the interest rate, so that if interest rate becomes more, then lesser number of people will be able to buy. If lesser number of people will be able to buy, then actually, if lesser number of people will be able to buy, then prices will drop. So the prices which were boomed will now start declining. And all of this which we are talking about, it is just short term cycles. Long term cycles have a different game. So all of this was 5 to 8 years. But long term cycles consist of a lot of these cycles, twist and turn and twist and turn. They all typically have a high and a low. The other high is obviously greater than the previous high, which means that the productivity line was increasing. Why was that? So borrowing, it's a human nature that we will use now to pay later. We will not work now, we will enjoy now in the hope that we will work later on. So as a lender and a borrower, if borrower wants credit and lender gives him some money in advance, so that the lender will be able to use store marts, his house, everything he can use, he will be booming. Because think of it like having some free money. Someone is giving you some free money, use it, use it, use it, use it. Because decreasing the interest rate and allowing everyone to purchase. We are now talking about the greater long term cycles. In a long term cycle span, typically, if interest rates are typically low, then you can use anybody's money and pay it later. So people use it to buy valuable assets, more valuable assets, more valuable assets, because they probably think it is not their fault. Actually, if you are given the task of having 100 rupees today or tomorrow, you will obviously take it today. So people use it and they purchase a lot of goods. Purchasing these lot of goods at a larger scale increases prices, because they have more valuable assets, and more borrowing will happen because it's at lower interest rate, and more borrowing creates a boom. This boom is the peak of the long term maxima. Because the income that users have generated is much less than the debt. The ratio of debt and income at this point is said to be a debt burden for that person. He then uses his properties which he has purchased, his assets, to for sale, so that he has the money so that he can repay his loans. Because of this, because he was also able to repay the loan because of a certain boom, he keeps on buying more and more, and he still remains credit worthy. Because this boom does not last ever long, what happens actually is the debt burden keeps increasing. Because think in aspect of the person who sold the plot. He sold it at relatively more price because of the boom, and now actually when people have come to realize the debts have increased a lot, they reduce their spending. Reduced spending means less income, means less borrowing, means debt repayment will take a lot of money from their hand, and this will result in a decrease in economy, and this long term debt will comes to an end. The boom. So for example, you can clearly see in this 1929 or that 2008 mark, what we were able to see was that economy just dropped down like nothing. So this is what is typically called as deleveraging. Deleveraging means people have to cut down on their expenses so that they can repay their debt, and also because their valuable assets have decreased in value, because nobody is there to purchase it. This typically creates a situation of revolution and a typical worrisome for all of the institutions. Even for institutions, if people will not be able to repay it, then it is also very difficult for an institution, because how will they get the money back? It is like saying, I will for example, he does not pay the 100 rupees back, forget the interest, he is not able to repay the principal amount. This creates a result in people selling their properties, their assets, so that they can repay their loan at any asset, but still the financial institutions are not able to get the same money back which they had thought while they were giving their money. So government uses some typical strategies from less, so that people spend less, and they can typically evolve from this course of depression and have a steady growth. So what does government do? There are in a recession, unlike in the short term one, government can't. It is very critical. Like in the short term cycle, we have seen, if people are having easily they are able to purchase, means the interest rates were quite low, so they were able to purchase. But even now the debt has become so much high that the law is also seeming to be impossible for them to pay. There is, if they even use it to zero, if if government just says that just pay now, just pay now, like the government did in near the 1940s mark, even then they have nothing to do, because in long term they have decreased decreased it so much that people are finding to repay it. They are not able to get the money. So financial institutions suffer a lot. They it is a depression phase for all individuals. So actually what happens, uh, the neither the lender nor the borrower is able to make money. So this decreases the credit worthiness of the entire economy. The debt of everything has risen. The banks are not able to make money. So what does an individual do? There are typically four measures: three involving inflation and one involving deflation. So all these three measures, three red and one green, will make everyone out of this depression. So all the governments use some forms of these to get it to normal state. All this England, Japan, Spain, Italy, everything. So the first would be to cut the spending. Everyone is trying to cut their spending because the debts have risen so much that they are unable to repay. Now this creates a situation called austerity, where the increase in income is not at all as relevant to debt. So when spending is reduced, people get some money so that the debt can be repaid. But it alone can't justify getting out from depression. Second method comes from of reducing this deflation comes from the aspect that unemployment. Think from a business's perspective. For a business, if he has taken some credit and he is unable to pay it because of the depression, because his assets are of no longer much value, because people have overspent taking the credit. Now what happens is they start cutting down their expenses and eliminating their employees. This elimination of employees are a very very bad symbol for a government. So what do governments do? They cut their debt. They try, from the lender's perspective, the bank who trusted the borrower that he will also pay the loan, now is in such a situation where he is not being able to get the principal back. So what they typically do is reduce their debt, so that obviously so that they can get at least some portion. But this also does not last long. The main second factor which typically is seen, and why people criticize the Indian taxation, is because of this factor of how the money from riches is transferred to poor through the tax system. We will understand this. This is like similar. The situation. Can you imagine? The situation is like giving him the credit cycle and just running away. Like you took some cold drink and just ran. Now debt restructuring, the taxation system works in such a way that because the debt has become so much greater that the individual is not able to pay it, what they typically do is go to the government. Obviously unemployment, go to the government. What do government do? Apart from this restructuring, we will understand this. The central government is basically involved in giving to the unemployed and also providing money to all the goods and services that the central government uses. Now, from the government's perspective, it must have to earn also a lot of money. To earn that money, what government does is increase in the taxation. So, but already think from this image is very 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 important. Think from taxpayers' perspective, they are also not able to repay their taxes. So government should not take extra money from that. But what can the government do? They have to take care of the unemployed, which were removed because of these taxpayers. And also government is dependent on some goods and services. And so these taxpayers have to pay some additional taxes because in spite of the depression. Now these lenders and taxpayers are typically rich people. So government uses this as a method to transfer this wealth from the rich to the poor. By levying more tax on the rich, the government states the rich to give the money to the poor so that again they can have some depression. This is the main reason why taxation works, so that the money from the rich can be transferred to the poor, because the government himself is not capable of collecting taxes from the cheap people so that it can pay to the goods and services that are required. So this typically generates some sort of revolt, like we have seen in some situations. This was also a part of the World War which took place, where every America to Japan, everybody had a deep impact. So this means that we should come to the fourth and very important prospect: inflationary method. Can't the government just print more money? Simple. If the government will print more money, the depression will come to an end, and inflation will begin to rise. But already the economy is down, so inflation does not matter at this point of time. So what actually happens is the banks just print more money. So what will the government do? How will it distribute this money to the poor? They just can't go take this money. So what the government does is, what the bank does is they purchase some stock and financial assets of the businesses, or take central government bonds. These bonds, when purchased, the banks give central government some money which the government later uses for the goods and services. We can typically see, like, this money which the central bank had collected is given in exchange for the government bonds. This money then the government distributes for goods and services and the unemployed. Now it may seem that this method is quite efficient and should work. Why is taxation being used? Think it from the rich people's perspective. The rich people had earned their hard-earned money, and now this money is distributed to everyone. This creates a sort of inflation. This will lead to inflation. It will put people in bad habits. So there should be a mix of taxation and this inflatory to have a beautiful policy. So this is called a beautiful deleveraging. Beautiful. Thanks for watching. This was the major chunk of how the credit of an economy works. Hope you like it. In the end, just one request: if you found that this video was useful to you, don't hit subscribe, just like the video. It would be sufficient for me to increase my motivation. Thanks for watching.